There's so much capital that could be mobilized to build and accelerate projects.
The positive is higher prices today mean more money going into the ground, more exploration, more funding for development and projects.
Social license to operate is a big catchphrase, but it's a good one because there is a social license to operate. You know, you need to do the right thing.
I would like to thank everyone for joining us today for the kind of kickoff to the one-to-one Mining Investment APAC online event. So this is the investment strategies session, bringing together a few of Australia's resources investors to talk about kind of just everything that's happening in the industry, themes, trends and all of that. So joining us here today, we have Matt Fifield, Managing Partner at Pacific Road Capital, David Franklin, Executive Director and Head of Funds Management at Argonaut, and Daniel Porter, Portfolio Manager for the Resources Fund at Pure Asset Management. So thank you everyone for joining us today.
Thanks, Amy.
Having us.
And just as a quick kind of introduction to the APAC event, it's starting tomorrow, and we are hosting, I believe, close to 60 companies that are focusing on gold, copper, lithium, nickel, cobalt, uranium, and then some. So please do feel free to sign up if you haven't done so already and book in your meetings. So to kick us off, I think it would be a really good place to start if we could talk about, the current geopolitical situation. So the Russia and Ukraine conflict specifically, as well as other kind of things that are happening right now in the world, how these types of global events are impacting the metals and mining and investment industries. So maybe Matt, if you could kick us off there.
Thanks, Amy. So look, obviously these are unprecedented times, well, at least in my lifetime, with the humanitarian crisis and the major land war in Europe. So we're all kind of learning how this comes. At the same time, I think that there's a piece of this conflict that has really just simply accelerated what's been going on. Over the last couple of years, people have been thinking a lot about supply chain resilience. COVID certainly brought up a lot of that in one respect. In the resource sector, we think about supply chain resilience, and we thought about supply chain alignment, and that's been a thought process that's been long in the making. People have brought it up, for time after time through critical minerals and critical mineral strategy, and with metals transitioning into energy. And the politicization of metals, what you're seeing is in the last couple of weeks, honestly, the last month, it feels like the penny has dropped and everybody has said, wait a minute, this is extremely important. Let's think about our supply chain resilience for the things that we need to operate how we are when something like 20% of a certain commodity sector suddenly gets sanctioned or becomes unavailable. So it's an amazing time from the whole world waking up to something that's been going on, and that's been reflected in business models. It's been reflected in inventory levels. It's been reflected in the LME flash crash around nickel and suspension of trading. So there's just a lot of dynamic things that are going on right now. But at the heart of it is that central theme where most people are now remembering that there's actually a really important factor around how you are aligned with your supply chain, not just that it exists.
Yeah, absolutely. I wholeheartedly agree with Matt's comments there. It's certainly something that we have been seeing over the past 2 years. Is a lot of that uncertainty weighing into miners' minds about where they're selecting or the geographical selection of trading partners and where they're sourcing their supply from. And I think certainly in the last 6 months, 7 months, even before the Ukraine crisis unfolded, certainly that thematic of siding with allies has been a big theme that we've seen in our dealings with the market. So there certainly feels like it's the whole global free trade patterns have somewhat shifted, and I think that's maybe a more medium term shift in that we're certainly seeing a dichotomy between, for want of a better term, East and West developing, and I think that's only going to be stronger over the next 2 to 5 years. So we might see some big changes, particularly in commodity prices, particularly if the world does sort of see a hiccup in growth, and potentially there's recession on the cards at some point. But equally, there may not be. So it's a very strange situation that we're facing, and I think you're seeing that play out in a lot of the commodity price changes. Gold is one where we've seen a lot of really strange moves, and on some days you think it's a store of value, and the world is using it as a great hedge, and on other days it's everybody's worst friend. So I think the volatility will be, probably the one thing we can bank on over the next 6 to 12 months more than anything else.
Thanks. I'll kick in now. I mean, I think at the outset, it's probably just worth reiterating, which I think the other guys have commented on, that, this is a humanitarian disaster, which really the world hasn't seen for a long time. And, the prospect of a nuclear confrontation is on the table. And again, that's pretty frightening. So, the big fact is that's going to have an impact on sentiment for the mining sector, but for the investment markets. And I think that's still yet to play out as Ukraine plays out. But it's important that we recognise that, we're there and supportive of Ukraine. I think both Dan and Matt have touched on really the critical factor from the investment perspective, and that is that really we're seeing a re-evaluation of trading partners, and I think that's going to continue going forward. And what we're seeing now is really a transition happening, which early stages, but I think it's going to separate the world to a large extent between the democracies and the autocracies, I think. Stepping back a bit, the macro themes that we're focused on is obviously Ukraine, Russia, and what transpires there. But I think, global growth is also important. You've got China shutting down a number of its economies on the back of COVID. It came out with some stimulus packages last week, which gave the market some concern. But you've also got inflation, which again is impacted by Ukraine, and that leads to higher interest rates, which could also slow growth. So, I think there are economic risks over and above Ukraine. So that's really how we see it. It's an uncertain time, but, on the positive, commodity prices, or some commodity prices, have moved higher, and that's created opportunity. So,
Dave, there's a couple things just to build on what you said. There's a couple things that would be interesting to compare notes on. First, I think it is just simply amazing the degree to which the global corporate community has turned its shoulder to Russia. And it is, in some ways, I view that as a follow on from stakeholder capitalism and ESG, and kind of the hardwiring of this is how we do business in support or defiance of how we are as humans. And so I think that is it, but it is just amazing to see the level of unprompted and to a certain degree there are some activist investors out there also prompted and unprompted cold shoulder towards Russia. So that's very interesting. I think it's going to ultimately be very difficult for Russia over a long period of time to reverse what's happened over the last month and a half, just from a global engagement. The second thing is that on one level, obviously, the solution to higher prices is higher prices. We're in this era of inflation and high input costs, and fears of a recession are there. When I dial back and I look at the fundamentals, the number one thing that we're focused on is there are no people. There are just no people in the industry. And remember, people build mining projects, people build companies, and people make the difference. So, while there are a varying amount, depending on the commodity, of projects in the development pipeline, and you could actually see that a number of those, a few of them are getting financed today, which is noteworthy, and a few of them are getting moved along. And in general, the cupboard is bare. The part that we're intensely focused on is, are there enough people, or are the people in the companies that we're investing in, up to the task, properly incentivized and motivated, et cetera? Because it's, now you can get in and out of Western Australia. Now you can get in and out of Australia, full stop. People are starting to move around the globe a little bit more. And so there's a change from the COVID lockdown eras to where we are today. But it also, that actually stretches people, because they can't just sit, they're not sitting at home, they're on a plane or they're moving around, and people capacity is really tight right now. And so when we're weighing up inflation and global slowdown versus the necessary buildup of pipeline in the, to supply growing markets, it's a really interesting dichotomy. One thing says things are going to cool. The other things say this is going to stay hot for quite some time.
Mm.
Yeah.
Interesting. Just as a quick reminder to our audience, we are taking questions, so please feel free to type them into the Q&A box. I wanted to follow on from this discussion to talk a little bit about, you mentioned that we've seen some extraordinarily high prices for metals. I mean, the situation with nickel, that happened, was it a week or two ago? And then also lithium has been surging to, record highs. What is this really stemming from, and how do you think it's going to impact the energy transition overall, with these high prices that we're seeing? So whoever wants to kick us off.
Amy, I'm happy to jump in there. I think you're right. I mean, if you look at the lithium price and looking at the spodumene price, which is a hard rock lithium product, I think in September 2020 it was trading at about $300 US a ton. More recently, it's somewhere between $3,000 to $4,000 US dollars a ton. Nickel, has gone from sort of $14,000 a ton up to, and it's kind of hard to know what it actually really is at the moment, but let's say 35 to 40,000 tons. So that obviously has an impact, and naturally that will have a dampening impact on demand. But I think probably overruling that is two factors. One is there is a global commitment to the energy transition, and I think what we're seeing demand increasing faster than supply, and that's forcing up prices. So I think the positive is higher prices today mean more money going into the ground, more exploration, more funding for development projects, and I think that's really positive. So it's probably a necessary evil to get where we want to go, because I think if there's one risk to the energy transition process, it's simply that supply doesn't keep up with the demand, and I think higher prices is a solution to that.
Yeah, absolutely. There's some of the conversations I've had more recently, and probably more with more the government side as well, has been a realization that any transition won't happen tomorrow. It's going to take some time to play out as well. But how do you facilitate that transition at the same time? So making sure that everyone's got energy, making sure that your network stays stable has become a really important consideration. And I think more so, out of Northern Asia and places like that, governments are very concerned about how they, how they keep and manage that transition period as well. But also cognizant of the fact that it is harder to find new supply of these products as well. It's great when commodity prices are high, every project looks good and every project stacks up. There will be swings and roundabouts. So what looks good through the cycle, I think, is also of firm consideration to everybody, not just what's happening now with commodity markets. But again, it comes back to who can we trust to continue to deliver that raw materials that we need.
Yeah. So in a global context, Amy, I'll just try to be pretty punchy here. number one, incredibly favorable for Australia and Australia, the Australian economy, the Aussie dollar. And if you just think about Australia just sits at the crossroads of energy transition materials and has some of the most intrepid mining companies out there. So I just feel like we're at the beginning of a multi-year run that's going to be very, very powerful for Australia generally. Second is expect more OEM integration. So if you think about, you've seen Tesla ink a couple of supply contracts into companies in our portfolio, and in general, and GM is out there as well. You're going to see more OEMs making sure that they have their hand on supply as they look to, look through their battery manufacturers into the scarce materials that can upset their business models. So that's just going to increase. The third thing is that it's honestly, quite obviously, a huge tilt towards producers right now, as opposed to explorers and developers. So higher prices do reveal that the cupboard is bare, but the people that benefit the most are the ones that are making cash from it. So people that are building projects inside a cash flowing company that have their commodity price double, suddenly there's a lot more cash to go around to pay for what is an offset in rising prices of labor, rising prices of capital. So second is that we have a whole crop of very disciplined producers right now that are returning cash to shareholders through dividends and buybacks. Higher commodity prices mean that investors are going to see more capital being returned to them for some period of time and until people start to lose discipline. So good for Australia, own producers, expect more OEM integration.
Interesting. I mean, a big part of this, you talk specifically about how the producers are really where it's at right now. However, there have been kind of a lot of reports out saying that what we have in the ground, what we've already kind of found, is not going to be enough to actually kind of help, or to kind of accelerate the energy transition. And we need to explore more and invest more in exploration. Are the funds also going into the exploration to kind of, I suppose, discover more of these minerals that we need?
Well, I'll take a quick crack at it and then compare notes with the other guys. What we're seeing is large generalist funds are going into the largest, most liquid names. You feel that capital coming because you see, just look at a few of the $20 billion companies that are now $40 billion companies, right? And so there is capital that is moving through the higher end, and then it trickles down a little bit into the mid-size. Below sort of a 250 market cap, it's still very much so this is a specialist game. That's why you have specialist managers online today. And so when you start getting into less liquid companies, there's more technical risk or industry knowledge, and that's not, there's more idiosyncratic risk in an investment that can't be offset by something else within that individual company. And so look, 15 years ago, there were a lot more specialist investors. Today, there are very few. And you're seeing a reemergence of specialist investors that are helping guide and provide capital. We're seeing a lot of privates, people that are getting things ready to come to market and trying to do a couple rounds of investment before it goes on the ASX or TSX. Look, the answer is when you're trying to 10x an industry, it's all of the above. So it's producers, it's developers, it's suppliers, it's people, and it's explorers. I would say that the further down the market cap spectrum you get, the harder it is to be organized to find capital, and some of that is because of the scarcity of the capital supply structure.
Yeah, I would agree with Matt's comments. I think we, as a fund at Pure, we specialize in that sub 250 mil market cap area, and it's definitely very hard to raise capital still for a lot of these companies, despite what we're seeing in commodities markets. And I think what it also comes down to is the type of commodity and jurisdiction. So even in Australia, where you've got a big tailwind on a lot of these commodities, and Australia is seen as a favourable environment, it does depend on state governments to a very big degree, and we're seeing a huge divergence emerge between states of those who are proactively pushing the mining industry versus those that are not. And you're seeing it emerge in resource and exploration expenditure over the past 2 or 3 years. This is not something it's just popped up overnight. This is a concerted strategy. You know, we're seeing Queensland and to a lesser extent Victoria pushing ahead. Victoria very much because of the gold side of things. Queensland is a resources state anyway. New South Wales, concerningly, is lagging behind on exploration in a huge way, which is a real concern given Sydney is, the biggest city in Australia and New South Wales is the biggest state by GDP. Unless something happens there, I think Australia's going to miss a big opportunity, and New South Wales will miss a very big opportunity in this transition and this commodity price boom as well.
Yeah, I guess, I'm based in Perth and, we see there's a lot of money, a lot of retail money rather than insto money looking for, small resources. So it's a pretty buoyant period there. I think, and you're even seeing some of the smaller cap funds broaden their mandate to include resources. So, I think if you've got a good project, I think you can raise the money. I think probably one factor is, we're seeing it's quite easy to raise money in Australia for a good project as long as it's in a tier 1 location. I guess the issue is that most of the great projects are not in tier 1 locations. They're in South America or Africa. So it's really bridging that gap. And that obviously raises issues around regulation and tax and geopolitical risk. But I think that's obviously another big factor there is where you're going to raise the market and where's it going to get spent, and there's a bit of a disconnect there.
Dave, to build off one of the things that Dan said, that's kind of interesting is the emergence of state capitalism in the West, right? If you think back to, you're seeing OEMs come in. It feels a little bit like Japanese, Korean steel market chain where, you'll expect to see a car company own 10% of a lithium project, right? Just to have a negative offset against price spikes and to make sure that they get the supply. So you can see that piece moving forward. But the other thing that's very constructive right now is in Europe and in the United States and in Australia, because of the criticality of supply chain, there's so much capital that could be mobilized to build and accelerate projects. And we've seen a real, when you go back to the thought process, whether it's ESG or being just very savvy and well connected around your business model and what you're trying to achieve, there are a number of junior and exploration and development companies that are starting to mobilize material support. And that material support acts as a flag to attract capital saying, hey, Western Australia is going to help, build a processing plant when it's time to do that, or Queensland is going to process our vanadium, or whatever it might be. And that flag of the stakeholder or the state capitalism, the support from governments is actually incredibly important. And I'd encourage any junior miner or actually any mining company to be really thinking at the board and executive level, what's our plan there?
Yeah.
Interesting. I know kind of various funding bodies throughout Australia, like government bodies throughout Australia, have put forward kind of these notices that they will be investing quite a bit, especially in kind of the energy transition and companies that are going to be kind of contributing specific metals to that. So I think there's probably quite a lot there.
I think Amy, just to add to that point as well, what we have noticed for a long time was sort of the reason for getting our fund at Pure together in the first place was the banks have walked away from the sector in a huge way, the retail banks, and I think that is only accelerating now, despite what we're seeing in mining commodities markets. And so that creates a huge gap that wasn't there 10 years ago. That base of capital, from the CBAs, the NABs, Westpacs, ANZs, is no longer there. And that's a big pool of funding that has just disappeared. So there is a huge...
For now.
Yeah. when they come back in, we'll know we've hit the peak. So keep your eyes on that. But that is a huge issue for the sector, in that project finance is very, very expensive now compared to where it was.
Yeah.
So kind of on track with this discussion that we're having about the energy transition, we had a question come in from the audience kind of asking about, there's been a surge in demand for thermal coal, and wanting to see kind of how do you see both the private and the public markets responding to this?
But public markets have responded. If you look at it, first of all, there are very few pure play thermal coal public businesses left globally. But when you look at prices of all coal companies, whether it's PCI, metallurgical coal, or thermal coal, they've all just absolutely exploded, with the recognition of the profits that are being made right now being substantial. But the coal environment generally has become less and less interesting to public owners, and so you've seen people. It's really just become much more of a private or hybrid type of a market, and honestly, I think that's going to continue. Where when you're in discussions around legacy assets, what I think has happened is that perhaps the pendulum has come back, and people have said, "Wait a minute, this is going to take longer." There's a growing acceptance of the need for all sorts of energy to fill the world, and coal has a place in it. But at the same time, it hasn't dissipated the demand for decarbonization over a longer time period. So to me, it feels like a temporary blip where the long term the business model remains, in most investors' mind, challenged. And therefore, you will continue to see divestments at very low prices from public to private. Although when people are making so much money as they are right now, it'll probably cool some of that divestment activity. That's my take.
Yeah, I agree, Matt. Some of the prices that we're seeing for private assets in that side of things are mind-boggling from how low they are. Right. If people own them at the moment, they're making a lot of cash, and that's good. Good for them. So they're looking to hold on to them a little bit more. We've seen a few assets come to market recently where pricing expectations haven't been met, but given the sellers, you'd probably expect that wouldn't be the case anyway. And I think you're right. I think public markets are becoming less and less interested even now. It's seen as a public market aberration. I think it will continue in the private sector for a long time, but there's only really two pure play thermal companies in Australia anyway, and their share price appreciation was probably it was significantly delayed compared to their earnings coming through, and the potential. The markets are normally looking ahead, and in this case, they weren't looking ahead. They were looking at what happened last quarter and responding on the basis of that.
Yeah, but one of the challenges are there's not a big vibrant group of coal developers right now, and it remains very difficult to access capital. And so I think that you'll see a continued crunch on supply. It's hard to invest in a business model that most people think is going away.
Yeah, I'll just add to that. I think as far as the decarbonisation process, moving forward, removing thermal coal from the mix is critical and important. But I think what we've seen, and particularly we've seen recently, is it's a transition. It's not a light switch. So it's not something you can switch off, overnight. So I think you're right. I think there's less. Demand is still there, and with no new projects coming online, supply is under pressure, and that's forced up prices. I totally agree with Matt and Dan. You know, I think what that means is you're going to see low multiples on those assets, but very strong cash flows. And logically, they're assets that will be housed in private equity and private hands. I think that trend will continue.
I want to shift a little bit to talk about some other metals. So gold kind of fell out of the discussions a little bit over 2021, but it does seem to be having a rebound now. So is investor interest coming back here, and why do you think that is?
Yeah, I think anytime you see uncertainty in the world and in investment markets, you do see a rally behind gold. I think it is still seen as a store of value and a hedge against risk. There are other ways of hedging risk at the moment. I think some of those that we've seen in the last few years, I think people are realizing that they're also not quite the hedge of risk that we thought they were, previously. I think there's been a lot of physical gold buying as well that's supported that price more recently, and probably from sort of 3 or 4 years ago as well. We saw gold prices really start to pick up steam at the end of 2018 and through 2019. And there's a sort of new base that, that was established versus what we saw in the previous 10 years. But there are a lot of projects in Australia that stack up really, really well now at gold prices where they are. And we're seeing a lot of demand for capital for, particularly for smaller operations as well. Obviously that's what we do at Pure, but there are a lot of smaller mid-tier operations that are looking to get into production or looking to come back to the market. The equity raises for those businesses, there is a market still there, but it's not the same market that it was 5 years ago as well. I think people still see risk in those small mining companies. And, to Matt's point earlier, the specialist funds are coming back into that small end of the market, but they're not all there yet. So I think that will build a head of steam over time, but it's certainly not a fluid type market at the moment, which is good. From our perspective, we can still make good gains in those areas by funding some of these smaller operations. But I think it will come back over time. And certainly as we see, that uncertainty still continuing to overhang, which I think would probably be there for the next 12, 24 months. I think that's probably a good medium-term outlook for these guys.
Yeah, I would add to that. You can argue gold's really doing what it should be doing in a period of extreme uncertainty. So it's nice to see the gold price coming back, and you've got, it's really fulfilling its role as a store of value and hedge against uncertainty. I think what's also interesting is, and Dan alluded to it a little, for the last year, you've had the discussion around whether gold's obsolete with cryptos and crypto coins coming in. And I think what you've seen so far is you've seen crypto probably perform like a more speculative asset and gold doing what it should do. So I think that's probably forced more money back into gold as a store of value. And I think you're also seeing some, central bank and, purchasing again because of the geopolitical situation. So, I think that's all positive. On the gold company front, I think what you're seeing is a real focus on those companies that have production growth and have good margins and long mine lives and can generate cash. And interestingly, often they're the mid-sized gold, new projects that have low OPEX and low CAPEX, rather than the bigger gold companies that are dealing with older assets that require more capital. So you've still got to be cautious and selective.
It's interesting from my perspective. If you look at gold price is going up, and gold price is going to go up and down, but costs have come up a little bit. And again, gold is just so relevant if you're looking at things for value rather than growth. So in a value paradigm, if you look at the gold market, you see companies trading at 2 times, 3 times, 4 times, 23, right? And they're just smashing out cash, absolutely smashing out cash. And they should, and they will. And if you think about gold in the context of Australia, half of the meters or more every year that are drilled in Australia are in gold. Aussie dollar remains at 74 cents, US dollar approaching $2,000, gold on a stabilized basis. this is a signal of extreme prosperity for all producers and in Australian gold. It's going to be an incredible run of profitability. And for aspiring producers, there's probably, we're seeing a lot of action with people that are looking to raise capital, to come into production or to grow. So when there's a lot of cash going around, there's not a lot of valuation going around, a couple different things will probably happen. I think you'll see a lot of M&A. I think you'll start seeing cash M&A. And you'll see people trying to grow their companies to be larger and more relevant. And so that's probably my baseline expectation for 2022, which is that if gold equities remain somewhat subdued and there's so much cash being produced, that cash is going to get turned around and spent to fund more profitable growth, because it is just a very profitable industry right now.
Good time to buy drillers, Matt.
Yeah. Tell me about it. Actually, that is very interesting, Dan. The service sector still feels very constrained, right?
Yeah, very much. Yeah, I agree.
Mm-hmm.
Why is that?
I think investors have been burned in the past, but in the services sector, I think there's less and less people who look at it in a detailed way. I think there's probably been a lot of capital that's been lost and inefficiently directed over the years. I think partly, and to Matt's point at the start of this, is people, just getting people. There's just not enough people around to fulfill a lot of these contracts. So while you're seeing a real boom time going on, you're seeing that divergence move between West and East Coast in Australia, very much so, where you've got a lot of people still on the East Coast, hardly anyone on the West Coast available to do a lot of these jobs now. And so that's really hampering companies' ability to deploy into new projects, but also monitor their existing projects. And you're seeing a lot of projects have hiccups as well at the moment. And a lot of them have been on the civil side, but these businesses are so diversified and so broad these days that they will do civil projects, government projects, and mining to diversify their risk. But we're seeing, the pro-build collapse. We're seeing other civil contractors collapsing at the same time. People have taken on a lot of fixed price risks. Inflation is going through the roof. Yes, mining is there and it will be a big component, but they're dealing with so many other issues in their business that the mining side kind of gets left behind as well. And I think, there's a lot of much bigger companies than there used to be in that services space. There's been a huge amount of consolidation. And I think that means that the focus purely on the mining services contractor isn't there like it used to be. But people also look at commodity exposures too, I think, Amy, and that's an important thing. A lot of these smaller contractors have a dedicated background, whether it be, might be a coal driller or a coal contractor or something like that. And that does overlay as well.
So we had another audience question that was looking at jurisdictional risk in terms of investment. So specifically, they were asking about, what's your view on investment in Eastern Europe? But I think kind of looking at, the whole world essentially, and wherever you choose to invest, how does jurisdictional risk impact your investment decision making?
Yeah, it definitely does for us. Oh, sorry, David.
No, you go, David.
Really quickly, sorry, mate. We've become more cautious, definitely, as a fund. We were looking more broadly, globally. We're really looking at more tier one locations, but certainly more recently, we've just gone as a fund. We'll just focus on Australia for now. The Eastern Europe situation, look, there will be money to be made over time, but for the moment, it's too risky for someone like us. But that's just our perspective. Other investors will no doubt have a different view to that, but no doubt there'll be plenty of returns to be made over the next 2 to 5 years as well.
Yeah, look, I guess being a mining sector investor, you're trying to manage risk. And if you can remove jurisdiction risk because you can get a similar commodity exposure in a quality company in a tier one location, you're always going to go for that. Obviously, there's opportunities where you might go to a higher risk location because you think the quality of the asset is sufficient. And in those circumstances, you're looking at sort of the tax and royalty and really regulatory regime. You're looking at the political situation and stability, and really access to infrastructure, which is a big factor. But in general, if you don't need to go there, you don't go there. I think the second aspect of it is once you're invested in a project in a second tier location, how is the market going to rate it? And I think looking at the gold sector, Perseus, for example, would need to produce twice as much gold as Northern Star, as Northern Star, or Capricorn, for example, to get the same market rating, because it's rated at half what those companies are. So that's the other aspect to it, is if the market's not going to rate it or is going to discount it heavily, you need to factor that into the kind of returns you may ultimately receive.
I think that there's, but very hard to build any more depth to what you just said there, David. It's just very well said. Our expectations over the next 3-4 years is that you will see an acceleration of renegotiations from different stakeholders. Think back of what happened over the last 3 years, right? World was in crisis. Governments have spent so much money. They need, they need to restore their coffers. And so, depending on if you're on a U.S. swap line or where you are in the context of debt to GDP or whatever it will be, this next resource boom that we're at the front edge of, it's going to be long and compelling and centered around energy transition. And I think that it is not too much of a stretch to envision 2010, 2008, 2010 carbon taxes, super profit taxes, renegotiation of royalty rates, all of the rest, where people will come up and say, wait a minute, you're making so much money, you need to share some of that around. Now that becomes the further away from Western rule of law, the more complex that becomes and the more capricious it becomes. So looking at how our companies manage, where's their exposure, how do they manage their stakeholder risk, who else is involved? Do they have IMF or other multilateral and NGOs involved to help with that? Because it's fun to take a shot at resource companies when they're profitable, but everybody forgets that part of the reason they're profitable is because the business is so hard. Right.
Yeah.
And so it's so it's really challenging. So anyways, when you step back,
I think that's a really good point. And I think what's fascinating is if you look at what's happening in South America at the moment, and South America is very resource rich, particularly in the commodities that everyone's after, copper and nickel. And what you're seeing in Peru and Chile is governments that are coming really on the back of disgruntled populations saying, we've been doing this mining for a long time and all we're seeing is the negatives, and not much is flowing through to the communities. And so you've seen political parties now winning, which are much more socialist and looking to spread the wealth a bit. And then on an alternative, you've got Ecuador, which had been very focused on oil and gas, just had an election, and the winner there is probably pro-mining, but you would hope we'll do it a bit better and spread the gains a bit more so it can be more sustainable. So interesting.
Well, if you go back to things like transparency, sustainability reports, what kind of partners you have, all this ESG thing, the trends that we're talking about are way bigger than any one mining company. Right? Just so much bigger it is. The ebb and flow of society and the need for people to sustain their fiscal balance and all the rest of that. But when you come back to it, the ability to say, wait a minute, we are contributing, this is how we're contributing, this is where we're engaging with people, this is a two-way street, we need to work at this as partners, that remains very important.
Yeah. I
mean, that's very nicely kind of led into my last question, looking at the role of ESG and kind of, the energy transition has really focused so much on the environmental side of things. So maybe if you want to just expand a little bit more about kind of the social, the governance aspects of everything that's happening within the markets, but then also how maybe just to kind of summarize how you look at these specific points when looking at opportunities.
So to build off of our, we're extremely focused on this in a couple different areas. To the extent that we're taking geographic risk within our portfolio or making investments in areas that, just straight off of that last question, really important to make sure that you're operating at the very top of the curve from a business strategy perspective, not just because it's also the right thing to do, but it impacts strategy, variance, success, and therefore people that are on top of that and on top of the curve working in will find more access to capital, not just Pacific Road, or Pure or Argonaut, but across the globe, you'll find more people willing to back you, invest in you, and give you higher valuations if you are doing that. The other area that it built off the very first part of our conversation, which comes back to ESG, is it is so important. There's so much money sloshing around and so many cookies you can get from state capitalism that if you are showing that you're a responsible neighbor and demonstrating those things that show how you manage risk and you're not going to blow up in, think of the government as an investor. Think about what they need to see, right? And so that's how you organize there. And that same thing is also true ultimately for customers. You'll find the car customer will show up and want to buy 10% of your project if you're, working through IRMA or, working your way down and satisfying their needs, that you're a good partner in the, and with stakeholders, and that you're managing your business well. So I would say that ESG is actually, it's a real on-ramp to where we are right now, and all the forces are working in favor of companies that are doing that, and we've seen that play out continuously in our portfolio over the last 6 months. And I just encourage people to continue to work in that direction.
You go, Dan.
No, absolutely. I think there's been a lot of unfair criticism of the mining sector in the past, but a lot of that has also been brought on the sector by themselves too. There's been a lot of miners who haven't done the right thing. I think social license to operate is a big catchphrase, but it's a good one because there is a social license to operate. You need to do the right thing. Regional communities in particular have seen some very positive impacts from a lot of projects. There's been some negative ones as well, but they are the ones who will be most impacted by this over time. And so I think, those companies who are doing the right thing, moving up the scale and trying to do the best that they can, mining is ultimately it's an intensive industry. It's big, it's dirty in a lot of circumstances. If you were aware of how your cutlery is made, you probably wouldn't eat off cutlery half the time. But to that point, we all need it. So I think those companies that are making the best of what they've got is certainly something that we value as a fund. And I think more investors over time, or not over time, but more and more investors now are looking at that as a big prerequisite to investing.
Yeah, look, I think if you're a mining company, ESG is top of mind, and I think you're probably seeing it more than anywhere in those energy transition commodities, where the OEMs are looking for a totally transparent supply chain where they can evaluate what's been going on from an environmental perspective, but also social and governance. And so I think really that's the business going forward. As an investor in the resource sector, I think you're seeing the same thing. I mean, if you don't have sort of an ESG filter going across the companies that you're analysing, then you're probably not far away from implementing one, right? Because I think that's becoming an important part where the investors into the sector want to know that they're investing in companies that are doing the right thing. So that's putting the pressure on fund managers like ourselves.
Absolutely. Some really interesting points today. And I think that's kind of a good place for us to wrap this up. I think, you know, it's been some really kind of insightful discussions today. So I really want to thank all of our panelists for taking part, and also the audience for the questions that were submitted. So again, one-to-one APAC is going to start tomorrow, first thing in the morning. So if you're not yet signed up and taking meetings, please get in touch and we can help you to sort that out. So, and yeah, looking forward to seeing everyone hopefully at a live event sometime in the not too distant future. So thank you.
Thanks,
Amy.